Absolutely. I was really lucky because trading is a business and you should treat it as a business. And there were certain things that, as I went through my learning process, I started assimilating to my manufacturing business. So I would look at my losers as a cost of business, and that I have to have those losers in order to generate my overall profits.
When I started trading, I was fortunate that I spent quite a lot of time in sports psychology, and I was beginning to get into and understand trading psychology. And I genuinely believed having that knowledge helped me to learn faster and to lose less. So definitely I think it can be an advantage. But I think there's a difference between reading about the psychology of losing or about mindset or about emotions in trading when you've never traded compared to when you have traded. And when I used to do a lot of work on the graduate training programs and we used to teach trading psychology, almost without exception, people would say, Steve, I understand there's these mental mistakes people might make and there's all these biases, but look, I'm a smart guy, I'm not going to make those mistakes. There's almost a little bit of it almost feels run your profits, cut your losses. How hard can it be? And I think at the early stages, it can feel a bit like that. Like we can kind of understand it conceptually. It's a bit like saying to a child, don't touch the flame. We know what it's going to be like if they touch the flame. They don't know what it's going to be like. They've got to touch the flame. And I think trading's the same. So I think you can understand the concept of it's hot, but I think you only realize it's hot when you touch it. So I think you can know the concepts, and that's helpful in advance. But I think there's still an element where people need to actually be involved in the markets. And this is what I found for myself, take some risk, have some wins, have some losses, really feel what it's like. And then I think you understand it more, and you're probably more likely to do the work that's needed to then train it. Because it takes a lot of work to train the mind and to train the body, the same as it takes a lot of work to train, the craft and the skills and the knowledge and the strategy. And that's really key. So we evolved with our graduate programs where we would teach some psychology early on, but we would do the majority of it kind of once they'd had some live market experience, just because it was much more meaningful. People kind of got it. But I think things around learning, how to learn faster, some of the basics around, thinking in probabilities, just kind of knowing some of that stuff up front is helpful. And then I think once you get into it, you start to really understand why it's really important.
The right people can change who we are for the better. And yes, we're blessed to have those people in life. Most of my mentors now are people who help me out from the standpoint of, okay, Rob, don't get too caught up in your last great trade, or don't get too caught up in, building a particular indicator. So they're more like a loving but gentle correction. They're making sure I'm mentally not kind of disappearing into my own head. But early on in my career, I had a couple of different mentors. I had one technical mentor who introduced me to the work of folks like Charles Dow and Richard Schaubacher. And I had another mentor who worked on the global investment desk of a major bank, who taught me the right way to understand macroeconomics, not get caught up in headlines, but have a process for understanding macroeconomics, which helped me unbelievably as a Forex trader. And then after that, a lot of it was time spent in my office and just looking at, kind of going back to sports. I love football. We're not going to have a football season, it looks like, this year. But like a good quarterback spends a lot of time looking at film of the opposing team. Well, I don't have an opposing team, but I do have a lot of charts I can look at. And a lot of it was just observation. And I'm with you too. You look at chart after chart after chart at some point where those synapses are firing, those patterns are, becoming more and more prevalent and obvious. And I think some of that is just being in the hours, like a good quarterback just watching film. So not a lot of mentors, but just enough to keep me on the right track.
We all learn differently. There's not a typical student. We all have different personalities. We all learn things differently. Some people learn by reading books and they find great help in those books. There's two books that I know the club recommends. And I have actually bought them. I've just never read them. That's because I learn by actually getting on with it and doing it, whereas some people don't. They like the books, and there's nothing wrong. We all learn in different ways, and it's not a race. And also the worst thing you should do, or you can do, is to compare yourself to another trader. Never compare yourself. It's your journey at your speed, and it's your future. Don't worry about what other people are doing. Just stick to your plan.
Embrace a philosophy that you want evidence. You want to gather as much evidence that you can to give you confidence that the pathway that you're following is going to get you to the destination you want to get to. So you've probably heard the expression, there are many roads that lead to Rome. Okay, so there's more than one way to trade, and whatever grabs people's interests, I just would encourage them to have an evidence-based approach that says, okay, if a particular idea takes your interest, fine, but look for the evidence that if you followed that particular approach, that historically you would have made money. Now that's a very simplistic idea, but if people can just adopt, or say to themselves, oh, I'd like to trade with more confidence, or I'd like to trade with more evidence about what I'm doing, that should give them more confidence. And then once you become an evidence-based trader, and mechanical traders or systematic traders or algorithmic traders, it means all the same thing, right? You have a very clear way of how you want to trade. Once you've worked that out, is you need to gather the evidence to see whether historically it's would have given you a positive expectancy. If you have a rising equity curve, and then everything leads from that. There's a lot of traps to be aware of. You don't want to fall into the trap of data mining, only trading those markets where your strategy looks really, really good on. Don't want to fall into the trap of curve fitting, where you probably use too many tools with too many flexible variables, which will remove some of the really nasty trades and maybe capture some of the really good trades. You want to avoid falling into those two traps. But as long as you have a belief that you'd like to trade, if you want more confidence in your trading, the best way to get confidence is to gather evidence that what you want to do tomorrow has worked in the past. Knowing full well that even though it may have worked in the past, as we know, there's no guarantees it will continue to work tomorrow. But if your methodology is robust, the odds would suggest that it should probably work okay tomorrow. And then if you embrace diversification, where you will trade multiple, diversified and complementary trend and counter trend strategies over multiple timeframes, whether it's short term, medium term, and long term, over a portfolio of markets, then you're insuring yourself against any individual market failure, or insuring yourself against any individual strategy failure. But everything starts from a desire to become like an evidence-based trader.
The probability, in fact, I said the probability of pretty much anything you do, buy or sell at any time, is between 40 and 60%. If you work out the math, as long as you go for a reward that's twice your risk, mathematically, you're going to make money. So if you just consistently do that and don't get impatient and, I've been losing, I got a small profit, I'm just going to take it. No, you got to hold, and because you need that 40% of the time when you make 2 to 3 times your risk, you need that to erase the losses. So I think that simple math is one of the keys to making money. Patiently find a setup, place your stop, and hold for a reward that is 2 to 3 times your risk, and be confident that 40% of the time or more, you're going to achieve your goal and you'll be a consistently profitable trader.
I love the data, because for me, it was only because I had gathered the data and done the back testing that I was able to continue trading through my drawdown periods, because I could refer back to the back testing and think, well, I know what my win-loss ratio is, and oh look, my worst run is 12 losers or whatever, and I'm only at 8. Actually, I don't need to worry because I've got another 4 to go. It gave me so much confidence doing the back testing. And also, I find that an issue that the new traders that come through the club, they're reluctant to back test, which I was initially. But once I saw the value of doing it, it changed my whole trading journey. It made it so much easier. And I had a rapid growth spurt, if you like, once I'd accepted that backtesting is part of trading, it's part of the business, and you have to do it. I would probably guess that there's a direct correlation between the successful traders, those who backtest, and the unsuccessful are those that don't, I would say. I don't know that, I'm just saying I would probably think backtesting's got a lot to do with it. You need to know what your win-loss ratio is and your trade frequency and what your worst run is. So with those bits of information, you can then calculate your risk correctly. Because I think it's about 10 strategies now that I swap in and out according to conditions. And each of those strategies, I'm trading at a different percentage risk per trade because the backtesting told me different things about the strategy. So it's not a blanket 0.5% per trade. It just depends which strategy it is. And that in itself increased my bottom line by 22% a year, just doing that one thing, working out the risk per trade for each individual strategy rather than having a blanket 0.5% or whatever.